Before we get started, Tom, before we get started, I just wanted to mention that Tom and I really enjoyed meeting a lot of you in person at the Invest Like a Monster conference in Newport Beach last month. So it was great to meet a lot of you in person, and we're looking forward to the next conference. So today we're going to talk about profiting using weekly options during market corrections. The market, as you know, has been trending pretty well up until the beginning of April. Now it's digesting a lot of those big up moves, and we've seen the market volatility increase, and the broad markets have declined in April, and this looks like just a normal correction that you have in every bull market. 3 to 5% is usually the extent of these types of corrections in strong bull markets. So right now, that looks like what we're in right now. So anyway, despite these, the increased volatility and the major averages being down this month, I've been able to profit with trading weekly options despite that correction and the increased volatility. And I'll show you how I did that in this presentation. And one of the things I do during market corrections is I adjust my weekly option trades. If the underlying stock declines in price and I have a covered call on that stock, I'll buy back the short call, usually at a very low price, and that allows me to sell a second premium. So I can actually double dip and sell 2 option premiums in 1 week, and I'll show you examples of that. Also, the trade selection process that we use can give your weekly option portfolio an edge with stocks that outperform the broad market and still do well even during corrections. Not all of our stocks have been profitable this month, but some of them have, and I'll show you examples of that. So, and the other thing, of course, you have to keep in mind with weekly options is even if the underlying stock goes down, you get 52 opportunities each year to sell option premium, which can more than make up for any short-term price declines in a stock. And you can receive as much as 100% cash-on-cash return with these covered calls, regardless of the price movement of the underlying stock. And I'll show you actual trades that I took that have the potential to deliver 100% cash-on-cash return, regardless of where the stock moves. And we also do option spreads, which can profit in any type of market. So just to cover the basics of weekly options, in case you're not familiar with them, weekly options, they start trading on Thursday and expire the following Friday, so they have a life of 6 trading days. So the April 27th options, weekly options, which expire next Friday, started trading today. So one of the advantages of weeklies is it allows you to start small, and if you're doing an option purchase portfolio, you can purchase 5 options with a total of investment of around $270 after commissions. And I've traded weekly options in a portfolio of 5 diversified options with as little as $270. So you can start small with weekly options. And again, you get 52 opportunities each year to profit. So the big advantage of having 52 opportunities each year is it allows you to roll over your profits and compound your returns, and this can make a really big difference. And if you compound something 52 times, you're talking about big returns. So That's one of the big advantages of weekly options is that they allow you to compound your returns. And I started out trading options with a $4,600 trading account, and since then I've made millions of dollars in profits trading options. So I think weekly options are the ideal investment for turning a small amount of money into a large amount of money. And the overall goals of trading weekly options would be price appreciation and then generating income from the sale of option premium. And we use three strategies to achieve these two goals. We do option purchases, we do covered calls, and we do option spreads. So I've been trading options now for more than 27 years. And as I mentioned, it's an ideal way for small investors to really get ahead. And when I started out with that $4,600 trading account, that's all I could scrape together at the time. But within my first 2 years of trading, I made over $460,000 in profits from trading options. And I'm just showing you copies of my tax returns those first 2 years of my trading. So I was able to turn a small amount of money into a large amount of money. So it's definitely possible. Now let's look at some more recent profit results. As you know, the market conditions the last 5 years have been really difficult. We've had a global financial meltdown, severe recession, bear market, high unemployment, increased market volatility, uncertain economy. So the last 5 years have been really tough on investors. But despite these difficult market conditions, my option investing strategies have produced over $3.3 million in actual profits over the last 5 years. And so the strategies that you're going to learn today to trade weekly options have been working well over the past 5 years. And I have copies of my brokerage statement showing this $3.3 million in profits in my Sure Thing Profit Secrets book. I had total profits over the last 5 years, $3,308,000, average return 69%, average days in a trade 67. So I've had an annualized return of 377%, 94% winning trades. So you can profit with options, despite these really difficult market conditions. And I use the same strategies, trend following strategies I've been using for many years to trade weekly options, and they work just as well trading weekly options. So let's talk
Chuck,
about
just a quick question for you. It has came up more than once. Weekly options are becoming such a thing on everybody's at the end of their tongue and at the end of their lips. Is there a way that people can see how new companies are starting to list weekly options? And if so, do you see that just about every company in the near future will probably trade weeklies?
Yeah, that's a great question, Tom. And if you want to find out which companies are trading weeklies, you just go to CBOE, Chicago Board Options Exchange.com, and just click products, and then click weeklies, and they will give you a list, the current list, and they update this just about every week. There's new companies that are trading weekly options, so you can get the complete list of all the ETFs and companies that trade weekly options at CBOE.com. So that's a great question, because not all companies trade weekly options. So let's talk about generating weekly income with covered calls. And you may be familiar with covered calls. With a covered call, you buy 100 shares of stock and sell a related call option. And once you sell that call option, that premium is credited to your brokerage account immediately. So if you sell 4 points of option premium, $400 in cash is immediately credited to your brokerage account. So this cash credit to your account reduces the cost basis of the stock, and it reduces the risk, the overall risk of the trade. So covered calls actually incur less risk than simply just owning the stock. So these can be traded in retirement accounts. I trade these in my retirement accounts, and this is a great strategy for developing an income stream with relatively low risk, because as I said, it's less risk than owning a stock. So now the beauty of weekly options is you get to sell 52 options every year, so that can really add up. And as you'll see, some trades I took last week that expire tomorrow, these actual covered calls have the potential to generate 100% cash return on your investment. So that's a really good return considering the risk involved. So and again, another big advantage of the weeklies is when you're selling 52 options every year, this allows you to compound your returns very quickly, because you can, once you receive that option premium in cash, you get to purchase more covered calls every week when you receive this cash income. So this allows you to compound your results, and this can really add up quickly. And let's just talk about the concept of the time value of an option, because this is really important to understanding covered calls. And it's the main reason why these covered calls is so profitable, is because the time value of an option equates to profit when you're short an option. And options consist of time value and intrinsic value. And if you're selling at the money or out of the money calls with these covered calls, that option that you sell consists of only time value. And options, at option expiration, options lose all their time value. So if you're short an option, the time value of that option becomes profit at option expiration, regardless of the price movement of the underlying stock. So that's the basic concept behind these covered calls. You're selling time premium in these options, and you get to keep that premium no matter what the underlying stock does. So I'll show you some examples here. This is a trade I took last Friday, and I already owned the J.P. Morgan stock. So what I was doing is I was closing out last week's options, which were the April 13th weekly options, and I was rolling them over into the April 21st options. And so what I did is I used a spread order, and I closed out last week's options and then sold to open this week's options. So this is the order I put in. J.P. Morgan was trading at 44.66. Here's the order I put in, and here's my fill down here. So I bought to close 12 of the April 13 options and sold to open 12 of the April 21 options. And this happened to be the 45 strike call, and I sold those at 75 cents. So I sold 12 of the new options, the April 21st, at 75 cents. And when I did that, you can see in my brokerage account transaction history, sold short 12 April 21st, 45 calls at 75 cents. So after commissions, I received $886 in cash that was credited to my account from the sale of those 12 options. So now let's look what happens through the course of the week. The JPM shares at the time were trading at 44.66. And if I sell the 45 strike call, that's higher than where the stock was trading. So that would be considered an at-the-money call or an out-of-the-money call. So that 75 cents that I sold was all time premium. So, and again, as I mentioned, the time value of an option becomes profit at option expiration. So that 75 cents or $75 per contract becomes profit tomorrow, no matter where the stock goes. So, so again, when I sold the 12 45 strike weekly calls at 75 cents, $886 in cash was credited to my brokerage account. So let's take a look of a situation where this can really add up over time. Again, the time value of the option I sold becomes profit at option expiration. So now I already own JP Morgan stock, but it was trading at 44.66 at the time. So let's say you were going to enter this trade as a new trade. I already owned the stock, and I was rolling over from a previous week. But let's say that you were buying at the same time that I sold the April 21st calls, and let's say you bought 1,200 shares of JPM at 44.66 minus the 75 cents you received immediately for the option premium. So your cost for this covered call would have been $43.91, and I did 1,200 shares, so the cost for my 1,200 shares would have been $52,692 investment. So your initial investment, if you were going to do 1,200, would have been $52,692. So if I was able to receive a similar cash premium each week, this $886, if you do that 52 weeks a year, it's really going to add up. And we can see that that 886 times 52 weeks. So I'm going to collect. I have the potential to collect $46,118 in potential time value profit versus my initial cost of $52,692. So if you divide this cash income that you're going to receive over the course of a year, remember this is time premium, so you get to keep this no matter what. You're talking about a potential of 87.5% cash on cash yearly return. So that's why these weekly options work so well with covered calls, because if you're doing this every week, it can really add up. And in this example I just showed you, for a trade that you would have taken last Friday, you have the potential to receive 87% of your cash investment over the course of a year, no matter what the stock does. So even if JPM stock declines 20%, I still have the potential to realize a really good return. So this selling these weekly calls week in, week out really adds up. And you can see 87% cash-on-cash return potential over a course of a year is an excellent return for this strategy. And as I mentioned, when you roll over these weekly options, like I did with my JPM calls, each week I'm receiving more and more premium, so that will allow me over time to invest in additional covered calls, which I actually do, and that can actually increase this 87% return quite a bit if you're compounding your returns, which I do. Now, let's say you had a smaller account and you couldn't trade 1,200 shares like I do. If you did 100 shares of JPM at 44.66 minus a 75 cent premium, if you did this covered call last week, it would cost you $4,391 plus commission. And if you receive a $75 time value each week times 52 weeks, you're going to generate a potential $3,900 in time value profit. And again, with the time value, as we saw, at option expiration, that becomes profit no matter what the stock does. So you have the potential of receiving $3,900 in cash on a $4,391 investment. So you can almost recoup your initial cost after a year by selling these weekly options. And again, even if JPM stock declines 20% or more, you still have the potential to realize a good return. Now, last week, I sold over $16,000 in option premium against my stock last week. And these brokerage account transactions show the date that I sold the call, the number of contracts, the stock that I sold it for, the expiration date, and the premium that I received. And over here is the dollar amount of the premium I received after commission. So last week, I sold $16,053 in option premium, which is the total of this column after commissions. So on a yearly basis, if I was to do that every week, I have the potential over the next year to take in over $834,000 in time premium profits over the next year. So again, if you do this every week, it can really add up, and I have the potential of realizing $834,000 in time premium profits, and I fully intend to realize that. Now, let's talk about market corrections. And this month, we've seen a market correction. A lot of stocks are down. The major averages are down. So what I like to do is what I call double dip. And what I'll do is if I have a covered call and the underlying stock goes down in price, it's not providing much more premium. And what I'll do is I'll buy back that short call and close it out. Then I'll sell an additional call against that stock. So I get to sell two premiums in 1 week. And I did that this week. This shows the calls that I bought back. And of course, that took about $1,000 in cash to buy those calls back. But you can see I bought this one back at 12 cents. So they didn't have much time premium left anyway, so I might as well just close them out and sell another one. I bought back the Apple calls for 76 cents. That's a low price for an Apple call when the stock's trading at $600. So I bought these calls back, and it cost me about $1,000 to buy them back. But then I turned around and I went ahead and sold another premium and collected an additional $6,600 this week by closing out the short calls and selling another premium. So this $6,600 would be added on to the $16,000 that I sold last week. So that's a total of over $22,000 in option premium. So this is one way that allowed me to profit during a market correction, this double dipping by closing out short calls and selling another premium and collecting two premiums in 1 week. And let's look at another trade I took last week. This was for Intuitive Surgical, and I bought 100 shares at, my brokerage confirmation shows I bought 100 shares at $541.22. Then I sold the April 21st weekly call, 550 strike call at $12.43. So this I didn't own intuitive surgical stock. So with this covered call, I bought the stock and then I sold the call at the same time. And because this was not a rollover. In other words, I didn't own the stock at the time. So this is a whole new covered call trade. So bought the stock at 541.22, sold the 550 call, weekly call at 1243, and my total investment after I deducted the 1243 I received for the option premium from the 541.22 cost. So the total cost of this covered call was $52,879. So that was my total investment last week when I entered this as a new trade. Again, I sold the weekly call for $1243, so $1,243 was in cash was credited to my brokerage account for the sale of that. So with ISRG trading at 541, this 550 strike call was out of the money, and it consists of only time value. So again, that $1,243 was all time value, and I get to keep that no matter what.
Chuck, a quick question for you.
Yeah.
These questions came up again a couple of times. Are you going after high-price stock positions such as the ISRG and the Apple computers due to the fact of the open interest and the spreads are going to be tighter?
No, that's not necessarily why I selected this stock. That's a great question, though. And I found that the spread between the bid and the ask on at-the-money weekly calls is very, very small compared to monthly options. So the spread between the bid and the ask on a large stock really is not that much. So it's not really a factor in my decision. I'm going to show you in a few minutes here the trade selection process, and that's what I use to select these stocks. And then when you're selling at-the-money calls with these weekly options, they're very liquid, and the bid-ask spread is very small. So it's really not a factor with weekly options. But that's a great question. So I pick the stocks based on the trade selection process, and then I generally will sell an at-the-money call or maybe slightly out-of-the-money call. So in this example, it was slightly out of the money. So let's just take a look at the potential to collect this time value premium over the next year. So if I multiply that $1,243 times 52 weeks, I have the potential to collect $64,636 in potential time value profit. And if we divide that by my initial cost of $52,879, we see with this trade I have the potential to collect 122% cash-on-cash yearly return. So that's a really good return. And even if ISRG stock declines in price, I still have a lot of profit potential because I'm going to be selling this premium week in, week out. And anytime you can get 100% cash-on-cash return for such a low-risk investment, it's really the best thing out there. So I'll just continue to sell these weekly calls every week on ISRG along with the other stocks in my portfolio. And each week I'm generating a lot of cash flow and a lot of time value profit. And again, here's my brokerage confirmation. Price executed, bought the intuitive surgical at 541.22, sold the 550 strike call at 12.43, and I plugged this into the calculator, and this calculates the yearly annualized return potential for this trade. In other words, it takes this time frame, and then if you were to do this each week, this trade that I took last week has a 4% return potential over a 1 week period. So if you annualize that, it comes out that this, writing these covered calls against ISRG has 146% annualized return. So even if you were to get half of that, to me that would be an excellent return for this type of a strategy. Here's another covered call I did last week for AIG. Bought AIG stock at 33.25. Sold the 34 call at 45 cents. And again, this if I did this each week, this has the potential to produce a 148% annualized return. And this trade I took last week has a 3.7% weekly return potential, and then if you annualize that, you're talking about 148%. So again, even if you realized half of this annualized return, you'd be realizing a very, very good return for such a low risk strategy. And here's one more trade I did last week. This was Wells Fargo. I already owned the stock, so I closed out the April 13th calls and sold open the April 21st calls, and I sold the April 21st calls at 61 cents. So plug that into the calculator, and Wells Fargo has a potential to make 114% over the next year. So this just gives you an idea of the return potential for these trades based on this 1 week time period that I own the stock, and the strike price and the premium, and this has the potential to deliver 2.8% over a 1 week period. So annualized return of 114%. So let's talk about the trade selection for a minute. And I use the same trend following and trend confirmation indicators that I've been using for many, many years to trade weekly options. And the first thing we do is we check to see if the stock is in a price uptrend. And for weekly options, I use the MACD or the 50-day and 100-day EMA trend following systems. And these have a long history of profitability with these types of trades. And we also, once we determine the price trend, we want to confirm the price trend. And I use several indicators to confirm the price trend. And as I mentioned, I've been using these same trend following strategies for over 27 years, and now I'm using them to trade in weekly options. So there's nothing new about these strategies. I've been using them successfully for many years. And here's an example of a confirmed price uptrend for Home Depot. That's one of the weekly option stocks that I trade. Home Depot, they have weekly options available, and we can see that the 50-day EMA, which is this blue line, is above the 100-day EMA. So the stock is obviously in a price uptrend, and there's a lot of, on any given day, there's a lot of stocks that are in a price uptrend. So we like to narrow that list down to stocks that have the best profit potential. So what I do to narrow that list down is I use these trend confirmation indicators, and we can see one of the best of the trend following confirmation indicators is the new 52-week high list, and you can see Home Depot's been making a series of new 52-week highs, so that confirms this price uptrend. And I also like to use on-balance volume, and we can see in this lower part of the chart we have on-balance volume, and this is the on-balance volume line right here. And in general, we just want to see that line sloping up. And if it's sloping up, it's confirming this price uptrend. And the volume flow can help sustain this price uptrend, and the way to measure that volume flow is with this on-balance volume. So I'm going to show you several stocks that I have in the portfolio that are up this month despite the market correction that we've been in for the last several weeks. And the common characteristics of these stocks is they're in a price uptrend, they're making a series of new 52-week highs, the on-balance volume line is sloping up, the price level is above 70 on a lot of the stocks, and they're in a leading industry group. So in my books, we go through these trend confirmation indicators in detail and how we use these. So I use these just as I do for monthly options. I'll use these for weekly options, and that allows us to select the stocks with the best profit potential. And here's some price charts of stocks that I have that I trade weekly options on. We can see the S&P 500 index as of April. It's down in April. So far this month, the major averages have been down. But here's a price chart for Chipotle, and you can see for April that it's gone up in price. Here's another example. This is for MasterCard. This is up so far in April, as opposed to the broad-based S&P index, which is down. Home Depot, that's up for the month. And Williams Companies, that's another stock I trade with weekly options. And I just wanted to mention one thing. Here's a price chart of the S&P with the Keltner channels. And if you've attended any of my previous webinars, on some of them we went into detail on these Keltner channels, but I just wanted to point this out, that normally a stock or an index doesn't actually close below the lower channel very often. It's very infrequent. The last time this happened was in November, and you can see that there's been a big rally in the S&P since it closed below that lower Keltner channel. And I'm always looking for that to happen, because it doesn't happen that often. But when it does happen, there's usually a big rally after that. It gets that oversold, and we just had one this month where the S&P closed below that lower Keltner channel. So there's usually a very powerful rally off of this signal. So I just wanted to point that out about the general market right now. And I'm just going to mention the rollovers, and I use a spread order to roll out of the weekly options and to enter into the new options. And here's an example for Wells Fargo. I was closing out the April 13, 34 calls and selling to open the April 21st, 34 calls. And what this allows me to do is save on commissions and save on the bid-ask spread. So I'm closing out the weekly April 13th and opening up the weekly April 21st. So I use these spread orders as a way to reduce my transaction costs. So just to summarize this, that double dipping in the trade selection process has allowed me to profit this month despite the correction in the increased volatility. And I just wanted to point this out. This is one of the reasons why weeklies are so much more profitable when it comes to covered calls than monthly options. And what I did is I took a snapshot of an Apple computer option chain, and at the time Apple was trading at 585, and the March 23rd options, they had 7 days to expiration. So this was the weekly option at that time, and you can see the 585 call, which would have been the at the money call with Apple trading at 585.57. You can see if you sold the weekly call, you would have gotten 14.05 in premium, 14 points and 5 cents in premium. So you would collect that over a 7-day period, and then of course I would sell another option at that point. Now, on the same day, you can see that the April 21st options, monthly options for Apple, the 585 strike was trading at 28.30, and there was 36 days to expiration when I took the snapshot. So that's just a little over 5 weeks to expiration. So I get to sell 5 of these weekly calls, and that would add up to 70 points of time premium versus 28 points over the same period of time, over the same 5-week period. So the weeklies allowed me to collect 70 points of premium versus 28. So that's why these weeklies are so profitable if you do it every week. And you can see, compared to the monthly options, that you get a lot more time premium selling the weeklies. Here's another example for the emerging markets ETF. You get 2.55 points of premium if you sell the weekly call versus 1.25 points for the monthly premium over the same period of time. So again, you get double the amount of premium if you sell weeklies versus monthlies. Here's a recent snapshot of my weekly option covered call portfolio, and I trade these weekly options in 2 of my retirement accounts, and I'm just showing you snapshots of these 2 retirement accounts, and I have $332,000 in open trade profits and an average return of 36.9%. This is the stock portion of my weekly. Here's the option portion, and again, these are weekly options that I sold against my stock. And here's my second account. This is a profit sharing plan retirement account. So in these 2 accounts, $332,000 in profits and a 36.9% return. And here's a snapshot of my portfolio from this is about a year ago. And I was writing the weekly covered calls, and I had built up my profits in this account. I had $323,000 in open trade profits, average return of 54.8%, and again, that's from trading weekly option covered calls. So this was about 13 months ago, and this account had an average return of 54.8%. And here's a snapshot of my 2009 trading contest. Now, in this contest, I traded covered calls, and in 2009, I won the contest with an annual return of 122%. And these returns were audited, so there's no fudging these returns. So trading covered calls in 2009 had 122% actual return. And one of the reasons I was able to get this percent return up so high was by rolling over the monthly options. At the time, they didn't have weekly options, but I was rolling over the monthly options, and that enabled me to compound my results. So that's how I was able to get such a big return over the course of 1 year. So I had 122% return that year trading covered calls. So let's take a look at generating income with CDs versus monthly covered calls or weekly covered calls. And let's just assume that you wanted to generate $50,000 in yearly income. So if you were to take your investment money and split it up half into 1-year CDs and half into 5-year CDs, and you wanted to generate $50,000 yearly income, it would take $6.7 million of CDs to generate a yearly income of $50,000. Now let's contrast that to weekly covered calls, and you saw where in 2009 I generated 122%. Last year I had a 54.8%. Currently 36.9%. So I think it's realistic that you could produce a 33.3% yearly return for selling these weekly options. So let's assume that you could generate 33.3% by selling these weekly premiums. You'd only need $150,000 to generate $50,000 yearly income. So it's $150,000 versus $6.7 million. And if you could generate a 50% yearly return, then you'd only need $100,000 to generate $50,000 of yearly income. So these weekly covered calls are a great way to set up an income stream for yourself. So I trade in my weekly option advisory. I trade covered calls. We do option purchases, and we also do option spreads. So if you'd like to take a look at our recent trade results, which are updated regularly, just log on to weeklyoptionalert.com and then click trade results, and it'll show our updated trade results. So I want to thank everybody for attending today, and I'd be glad to, we're kind of running out of time here. I was going to go into some of the other weekly strategies, but we can do that at another webinar. And just want to thank everybody for attending today, and I'd be glad to answer any questions.
Yeah, Chuck, I appreciate you doing that. And hopefully we can do another webinar in the short term here to cover some of the other strategies utilizing weeklies. A few people are asking how you feel about May. When in May can you go away?
Yeah, that's a great question. And the way I would answer that is I don't try to predict where a market is going. I simply use my strategies and indicators, and I just trade away using those strategies and indicators that have been working so well for so many years. So I just follow those, and I don't worry about what's going to happen in the future. However, I think if I was to guess, and again, I normally don't like to predict, but if I was to guess, I would say that this year you want to be in the market in May, unlike previous years. And I say that because I think we're in the type of bull market that I saw in the 1980s and the 1990s, and we're long overdue for that. You know, the S&P is trading below where it did 12 years ago, so stocks have gone nowhere for 12 years. So I think the market's way undervalued right now, and I think this year, you know, it has the potential. The S&P has the potential to deliver 30% this year, and I'm seeing the same kind of bull market that I saw back in the 80s and 90s. So to answer that question, I'm not going away in May. I'm going to keep selling my weekly calls and collecting my income. So I'm going to kind of ignore that.
Sure. So you invest in companies, you don't invest in the market.
Right, exactly. Sure, yeah.
Sure. Chuck, last question for the day. I know we have so many people asking you questions, and again, here's Chuck's website, etc. send Chuck an email. His support group is really strong. They'll get back to you. They'll address any questions you have. But regarding option spreads, hopefully we can go over some of the option spreads in our next webinar and cover the weeklies, if that's all right by you, Chuck. A lot of people are asking about spreads and weeklies.
Yes, yeah, that sounds good, Tom. So we'll cover that next time. And again, I want to thank everybody for attending, and